Hello and welcome to Options Guide TV. My name is Brian Overby. I am the author of the Options Playbook, and I'm going to be your host here for about the next 25 minutes here on Options Guide TV. Wanted to do a quick review of the Google trade that we talked about at the last show. Things worked out on that trade, but it was an earnings play, hoping to get a little bit of upside momentum in Google, especially considering where Google was at on the chart. This is a little bit of a breakout to the upside. We're actually broke through the 50-day moving average, which has been quite some time since we've been through the 50-day moving average on Google. So overall, that's a good thing. The company has really taken a beating, and it's not necessarily because of the fundamentals or the numbers. It's all about perceptions and what may be going on behind the scenes to their search domination. So because of AI, because of what the government is doing, thinking about trying to split them up in some way, shape, or form to try to separate out the search, that they have such a monopoly is what the government is saying. So I'll use that word. And as far as search is concerned. So let's look at the chart. Let's start by going to the chart for Google. And if you do have any comments or questions on any of these strategies, do feel free to put them in the chat box. We will try to address them at any point in time during the show. I'm highlighting where Google is at right now. On the open, it's up another $3 today. So we're showing a lot of strength. Let me go out 1,500 days so that we can just get a little bit better drawing of what has actually been happening in Google. So had a lot of volatility throughout here, right, for a mega cap stock, where the stock goes way up. They have questions about AI. This is all generated by AI and concerns about search. Looking really good. Then all of a sudden we're not. And then the government kind of steps in this range down here. And then they have earnings and they report good earnings. And the one biggest thing about Google that's always interesting to me is that they never really focus on their stock price during their earnings reports. They give they will give guidance from time to time, but they just don't really try to overhype the underlying stock. So when you get a big update on a decent earnings report, that can add to a lot of momentum above and beyond, because it's truly because of what what Wall Street thinks of what's going on with their earnings and their growth going forward. Okay, so let me zoom in this corner of the screen. And you see that right here is the 50-day moving average. So it's been a long time since we broke below that 50-day moving average. We're going all the way back to February 7th and haven't even looked at the 50-day moving average for quite some time. Right here, this is actually considered a death cross, where you got the 50-day crossing below the 200 days. So normally that is a big down day, but it kind of signaled a shift in momentum. Underlying stock here, this is where the earnings are at, and we're at 162.84. And I think the path to least resistance is going to be to the upside going forward over the next month or two. I think it was a little bit overblown, trading at a PE now of like 18 times or 19 times earnings. They have everybody has exposure to what's going on in the trade war, especially a mega cap company. But advertising is probably their biggest exposure. But one of the biggest things that Google has is YouTube, and they kind of keep it hidden a little bit. But YouTube has always done very well. They talk about, they just get so much free content that they can earn income off of via all the postings inside the YouTube. And then you would think, the discussions with TikTok and everything that goes along with that. Once again, just a lot that goes around Google has to do with news headlines, not necessarily what they're reporting on earnings. And we saw that after this report and this pop-up. So filled this gap here, hanging out right here. Next high, next resistance level is right here at 170, pretty close to that 200-day moving average. If I'm in this range, I might actually look for a little bit of a bounce back or a little bit of a give back right here is one area where I might want to get bearish on Google, at least the first time that it approaches it, right around 170.5, right in that range as the 200-day drifts down and we get to the most recent high that's all the way back here. Okay. Now, the trade. Let me pull up. I have it in the what if calculator. We did a very simple trade and literally just tried to manage our risk and looked at have a little bit more reward versus the risk. And so we put a 10-point wide spread on a bull call spread that wanted the market to go up after earnings. We paid $4 for that spread. That means that we went a little bit in the money on the call side, and we went a little bit out of the money, or I'm sorry, on the long call side, and a little bit out of the money on the short call side. So the strategy that we did was when Google was trading right around 160, we bought the 155 strike call and sold the 165 strike call and did that for a net debit to the account of $4. And right now we see it trading at $7.75. This is the profit and loss graph at expiration, which is as of, well, today is the 25th. So it is as of today that this will expire. The maximum it could trade for is if it does wander on up to the 165 level, and we are at expiration. So this could trade for as much as $10. At right now, I would say we take the trade off and we don't take any risk going into the end of the market. Now, more than happy to try to play it. And the way that I would look at it is if I did 2 of these trades, I know that time decay is my friend right now. And let's go back to trade. Let's go back to here. Let's do it this way. All right. We're going to go back to the what if calculator and send a ticket. Yeah, that's what I want to do. And if we look at the actual chain of the option contracts in Google, or Google, that's the one that we usually trade, is we see that this 165 call, which we have to buy back, is still trading for 30 cents. So that is costing us. We're at 162.39. We would have to pay that 30 cents to close. And every hour that goes by, I mean, we're going to lose a dime in time value for that it doesn't get up to 165 or basically just stays where it's at. So is it worth the risk to not have to pay anything to buy back the 165 call? The risk is that the market could go down, right? It could give up some of the gains. It's showing some strong momentum, though, at this point in time, up 2.25%. We have the SPX actually, well, it's flat today. It was up a little bit, but now at this point in time, we're trading flat in the SPX. So it's a toss-up. I personally would just close it. It's earlier in the day. Like usually to get that upside momentum, things can switch fairly quick. We're at midday at this point in time. Close it out, take the gain. You put it on for $4, taking it off for $7. Well, it's $7.75 is where it was just at. Now we're at $7.60. So you would flip the script. You take this and go from a buy and make that a sell. I'm going to say open because this is a fake account. And then we sell and then we buy here. So 762 would be the net credit to the account, and we're unwinding that trade. Any questions on it? If you have any, please do put them in the chat box, and I'll be happy to address them a little bit later on in the show. Now, we have this one is a tough trade. NFLX, Netflix. We were pretty much right until we weren't. I guess, I mean, that happens a lot in the technical analysis world, but Netflix, we talked about a butterfly, a skip strike butterfly, where we brought it in for a net credit at the recent high. So Netflix is a kind of a darling of the marketplace. It's been determined that the trade wars are not really going to matter to Netflix. Well, at least that's the thought. The most recent high was right here at 160, And we did, after we put the trade on, we had the market actually hang out there for a minute, which was not a good thing because it was too soon. Well, actually, let me tell you what the trade is. I'm just assuming that you were a part of the show on that day, and that might not necessarily be the case. Okay, so with Netflix, we had the market trading at, need to make the screen a little bit bigger, 1,000 exactly. So when the trade was put on, we were right at 1,000 in Netflix. The expiration was this Friday, the 25th. We bought the 150 strike option contract. This was our first contract in our, and we got the 25. Okay, in our butterfly. Then we sold 2 of the 160s. I mean, this is going to be ugly. And then we bought 1 of the 180s. Okay. 1, 2, 1. Okay. $7.85. So the maximum you could lose on the trade is $10, or the maximum that this could trade for would be a $10 net. Well, we're doing it from the buy side, so net credit to the account, which means we'd have to unwind it. We'd have to pay that. So if we wait until the expiration today, we would be at a max loss on this trade. We did this entire trade for a net credit of 44 cents to the account, hoping that Netflix would stay below 1,050 or creep up to the 1,060 level. All right, that was the skip strike butterfly. Now, a lot of opportunities to get out, even though we are looking ugly on the actual expiration, because what we were saying when we first put on the trade, stock was right around here. Look at the strength and momentum to the upside. But stock was right around 1,000, looking for it to go all the way up to 1,060, which is the most recent high, and thought that there would be some support, and there was. So we came up, we bumped against it, ended up closing below at 140. Next day came up, tried to bump against it, ended up closing below. And now here we see it coming all the way down to the last day, and we see the market going up. The open today was 1,097. We're at 1,000. We're actually giving away $1 at this point in time, which wasn't the case earlier. But we had a solid close up above yesterday in the marketplace, and now we find ourselves today just kind of hanging around at the 1,096 level. So 2 days ago, when we closed here, probably should have got out of the trade. And I kind of mentioned many times, if you hit the 160 mark, you really need to get out. Now, it would have hurt a lot, and it wasn't there long when it came on this day, whichever, let's go back all the way back to here. What day was it? That was the 23rd. I think that was the day after we entered the trade. No, the 23rd was Wednesday. We put it together. Yeah, we put it together on Monday. So with that mentioned, when we did this trade, the next day on this is the 22nd. So the 23rd, when we bumped up against this level again, we should have definitely got out, right? Every time that you bump up against a resistance level, it's harder and harder for that resistance level to the upside to hold. And so this time, on the third time, no problem breaking through it. And it did. And then it made a strong move up. And now here we are, hanging right here for the day. So it's a tough trade because we only talk about the trades here on Monday, Wednesday, and Friday at 11 a.m. Eastern time on Options Guy TV. But if you're closely watching the trade, you probably would have got out. You might have got out. I highly doubt that you got out and salvaged a profit on the trade, but obviously the pain would be a lot worse than it is right now. If the market was still hanging here at 160 and it would have supported it one last little bump here on Thursday, well, then this trade would be really interesting because we'd be in that profit zone. We'd be landing right in here. And let's run over to this, send this to the what if calculator. And this is where we'd be landing, right? We'd be landing somewhere within that range of 150 to 160. If the market just hung, this is where our resistance was. This is where it was struggling to break higher. And this would ideally be where we'd want to end up at. But that wasn't the case when it was all said and done. Any questions on that one? Nope. Well, we're on a roll so far. Let's see. Comments. No. Okay. Next week, we got a bunch of trades that we're going to be looking at. We have the continuation of the Meg 7, the Magnificent 7, we'll be announcing. We got Meta, we got Microsoft on Wednesday. Then we have Amazon. We have also Apple that are going to be announcing coming up here very shortly too. And that's going to be at the week out, looking into May 2nd. No, May 1st is Apple and Amazon. So we'll have a lot of things to be able to talk about. And as always, remember this. We're not saying that you should only trade around earnings. We're doing trades around earnings because we do a 3-day-a-week show, right? So we also do other trades. Like today, I'm going to set up just a good old SPX bear trade because I do think that we've had a solid run up. A little nervous about what will happen over the weekend, so I want to get bearish. I'm going to keep the Wednesday theme. We're still at 26 on the VIX index, but it's always interesting to look at trades around earnings because you do know the stock is going to do something and see which way it's going to react. So we do a lot of trades around earnings here on Options Guy TV, and it's mainly to learn in the short term what can happen with these prices. And on top of it, we're taking a stance. We're looking what direction we think that underlying market can go. This Netflix trade, I liked a lot. I really did when I first put it on. I'm already out of it in my own account. I did put the trade on by myself, but I got out as soon as we hit that 160 level, just like I said. And with this trade, the way the setup was and the way the chart looked, after the solid earnings report, so remember the stock was around 1,000, saw it come back up, kind of hang around a little bit in this area, solid support right here, but it did not hold. And that's why we totally did this trade when the market was trading right around 1,000. I would do it again, even though it didn't necessarily pan out. I just like the setup of the trade. And more times than not, when the setup is this good, the trade's going to work out, and you're going to at least make the net credit that was received from doing the trade, and then potentially make a little bit more. All right, let's go into the SPX. So I want to stay bearish. I think that the 5,400 level in the SPX, 5,486, the fact that we broke through it is kind of a good thing, but I do think that in the short term, we're getting a little bit overbought, and Mondays are always kind of sketchy days in the marketplace, especially at this point in time. So I see that I am not going anywhere right now, and the SPX has a tendency to do that when I'm doing a webinar. Well, with the market at 5,400 and the VIX trading around 26, the trade that I would look to do is buy the 5,480 strike put. I'm going to go down 15 points, and that will put us at 5,465. Still hoping that we move here on the screen. 5,465. And then we're going to go down 10 points and go to the 5,455s. Getting that same scenario. Have to turn it off, turn it back on to get it to run. Should be looking to pay about $275 for that trade. We're going to do the Wednesday expiration. Wednesday would be, this is how often that we've done this trade, especially recently, that I pretty much know where it's at. April 30th expiration date, that was what we would be looking at. We're going to buy the 54.80. Okay, 54.80. 54, sell 2 of the 54.65s, and then buy 1 of the 54.55s. Looking to pay about $2.75 for that with the Wednesday expiration. All right. Well, let's zoom out for a second and see if we have any questions or comments. If we do not, I might just let that go and look at that trade. But bottom line, we're going to get bearish going into Monday. We can adjust it on Monday, and that is a benefit if the market does open up and this strong up move continues into next week. Then we can come back and we can adjust it on Monday. But I'm going to write down those strikes, and I will go and make sure I know where the quote is at. But I do assume it's going to be right around $2.75. And that's going to be it for this edition of Options Guy TV. So, solid trade in Google. I don't know trade in Netflix because there were many opportunities to get out and a lot of warning signs on that trade, but it didn't turn out as well as I had hoped. And then we're going to get bearish on the SPX, trying to sell some of this upside momentum. The marketplace just isn't strong enough to continue on up with the uncertainty with the VIX at 26, which means we've kind of waned a little bit. And a little bit of nervousness has left the marketplace, but that's where we're at. And we'll see you this Monday, 11 a.m. Eastern Time, inside hub.tradier.com for the next edition of Options Guy TV. Thanks for tuning in.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.